Every month, millions of people open an app on their phone, enter an amount for their systematic investment plan, or SIP, and tap confirm. It feels like a direct transaction. You hand your money straight to the asset management company, the financial experts you trust to pick the right stocks and grow your savings. But asset management companies are staffed by investment analysts, not data processors. They are unequipped to handle the operational chasm of verifying identities, updating folios, and routing payouts. This is where CAMS enters the picture as a registrar and transfer agent, sitting directly between investor and fund managers, acting as the digital plumbing that executes the trade. Scale in modern finance is defined by the underlying data flow, ensuring that every digital pulse translates into a confirmed transaction without dropping a single digit. In India, CAMS controls nearly 68% of the entire mutual fund market's infrastructure. If we look closely at this investment memo, you can see exactly what that market share translates to. They are processing over 600 million transactions every single year for 15 of the country's major asset management clients. With 600 million transactions moving through their servers, CAMS has become the industry's operational engine room. If these systems stop, the movement of private wealth across these 15 major funds stops with them. Since CAMS doesn't actually invest any of this money or take on any portfolio risk, how exactly do they generate revenue? Their primary income is AUM-linked fees, a microscopic fraction, typically 2 to 4 basis points, charged on total assets under management. As the mutual fund pool expands, CAMS's tiny sliver grows with it, capturing market upside without betting on a single stock. But that exposure cuts both ways. If stock prices fall or investors pull their money out in a panic, the total assets under management shrink and CAMS fee revenue drops instantly. This Q3 earnings transcript reveals their second major vulnerability: regulators. When SEBI forces mutual funds to lower expense ratios, those funds protect their margins by squeezing CAMS for lower fees. Management noted this could hit them for up to 25 crores. They operate essentially as a digital toll booth. They collect a fraction of a cent on every car passing through, which works perfectly until traffic slows down or the government caps the toll. With asset management companies facing those margin pressures, it seems logical that they would just shop around and switch to a cheaper data processor. The barrier to leaving is migration risk. CAMS holds decades of relationship history and compliance records. Moving 50 million investor folios to a new provider introduces catastrophic operational risk for the fund manager. Furthermore, every new client that plugs into CAMS makes the overall system more valuable for everyone else, enabling unified reporting and cross-platform analytics that a smaller competitor cannot offer. This competitive moat exists entirely behind the scenes. Retail investors don't choose their transfer agent. They are locked into whichever system their chosen mutual fund uses. Now, CAMS is taking that exact same B2B infrastructure and applying it to new markets, building a non-mutual fund segment that already accounts for 14% of their revenue. Looking at this platform diagram, you can see how they are expanding. They are moving digital payments through CAMS Pay, digitizing vaults of insurance policies with CAMS Rep, and processing complex alternative investment funds. They have engineered an ecosystem so sticky that the risk of a botched data migration outweighs the pennies a fund manager might save by leaving. Maintaining a zero-fail digital toll booth on this scale requires serious capital. Their absolute largest expense is talent. They pay competitive salaries and benefits to an army of specialized engineers and data analysts just to keep the routing pipelines flawless. Right behind payroll is the hardware itself. CAMS spends heavily on acquiring servers, upgrading software, and accounting for the constant year-over-year depreciation of their technological infrastructure. The current surge of retail investing in India is a modern financial gold rush, with millions of new accounts pouring into the market. In a gold rush, the most consistent profits don't go to the prospectors digging in the dirt, or the asset managers trying to claim the best land. The most reliable business model is owning the only digital pickaxe factory in town.